Welcome, everyone. Episode 6 of Portfolio Talks. And today we're going to be talking about salary or dividends. If you're a doctor in Canada, this decision was going to cost you hundreds of thousands of dollars over the longevity of your career. And oftentimes, when we hear about this discussion of salary versus dividends, it's usually because you talked to your accountant and it's a tax filing decision based off last year, as opposed to a tax planning decision on the longevity of your career. So oftentimes, you don't really know what to do. You just kind of do a knee-jerk reaction and like, okay, cool, we'll just dividend it out for the year. That one decision over the entirety of your career is going to be compounding more and more and more problems that you're turning off levers that you can use at the latter part of your career to wind down your wealth and enjoy it. So in this episode, we're going to talk about why that is and what you can do about it. And before we jump into the episode, be sure to like and subscribe so we can keep on growing this platform. And with that, let's jump into it. Episode 6, Portfolio Talks.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking round the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
All right, Tyson, we are back. Episode 6, salary or dividends. But before we jump into that, what is new in the world of Tyson Nagasaka? How's your weekend?
Weekend was good. There's always stuff going on. I had a lot of, just like running around and catch up on stuff to do. And then we had a very special first birthday party to attend, and it was awesome. So happy birthday to Amaya. But I haven't been to one of those in a long time. My kids are a little older, so it was nice to get back to one of those. And the amount of work, organization, and details and stuff, I was like, man, I've done it. I don't know if I miss it. It takes a special person to do that.
Yeah, and that special person isn't me. It was, for those of you who don't know, it was my daughter's first birthday over the weekend, so it was a production for sure. And it was so funny because it was great to see Tyson, his family, his kids, all my friends, all my family, everyone in one spot is always a blessing. I think it's times like that that you see all the love in the room, and everyone from different avenues and aspects of your life in one space is such an amazing gift to be able to have. So that's a beautiful thing. But it's funny because everyone's coming in like, oh, you guys did such a great job. The venue's great, the decor, all that kind of stuff. I was like, appreciate it. Talk to my wife because I didn't do anything. I just showed up. I felt like I was also surprised. My job, actually, funny thing, side story. My job, I had one job, which was bring my daughter to the venue, get her ready and bring her to the venue. So I did her nap time, fed her in the morning, all that kind of fun stuff. And when I was getting her ready in the outfit, I pulled up and I got her dress. And usually, for my outfits, I usually go based off the tag. So the tag is always in the back. So I picked up the dress and I looked and there was no tag. And instant panic. I was like, oh God, which way is the front, which way is the back? I kept turning it back and forth, back and forth. I was looking at it from different angles. Only thing I had to go off was the buttons. And I was like, the buttons sometimes are in the back. I'm like, but it kind of looks like it should be in the front. I was like, whatever, it's 50-50. So I put the dress on, got her to the venue, and I bring my daughter inside. And right away, I think it was my sister-in-law first. I can't remember. She's like, hey, her dress is on backwards. I was like, damn it, man. I had one job and it's 50-50 and I got it wrong. But it was funny. I didn't really know anything like the decor. I had no idea. So I walked into the venue. I felt like me and my daughter were both surprised at the same time. Like, whoa, look at the balloon garlands. Whoa, look at the coffee cart. Whoa, look at all this stuff, which is great. So I love it. I'm a guest on my own party, which is always a nice thing. But I was laughing so hard about the dress. I was like, man, no tag. So if you're someone that's making clothes out there, put the tag on the back. So it just makes your life a lot easier. So I know which way's the front, which way's the back, or else it's just embarrassing, you know?
Yep. Been there.
Crazy. Okay, well, let's talk to the docs about their taxes. I think this episode, we wanted to kind of build upon our last episode. Our last episode, we talked about tax filing versus tax planning. Two very, very different things. And filing is just the reactivity of your taxes when it comes to tax time, especially personal tax year end is always the most profound of the two, because that's the one where people kind of forget about things. We talk about shareholder loans, or like, oh my God, I spent so much money, or this and that, versus tax planning, which is doing frequent check-ins throughout the year. So if you missed it, if you want to learn more about that, go back an episode, listen to episode 5. So this episode, we're going to talk about, that is being done. And now you have a decision, again, either reactive or proactive, about salary or dividends or both. So let's jump into that. And let's first talk about the biggest myth that we hear, which is dividends are always more tax efficient. Always caution when it comes to definitive statements as like always, but in the world of finance, that's always one thing I remember when I was doing my CFP exam. Our prof, Jason Watt, great instructor, was always saying, anytime you hear definitive statement in financial planning, it's always a cause for pause and just double check that math. So dividends are always more tax efficient. Is it a myth? Is it not? Let's jump into that, Tyson.
Yeah. I think for a lot of what we see out there in the marketplace, there seems to be maybe it's a method of training, or maybe it's the software that our clients' accountants use. But that is something that's super common is dividends are more tax efficient. You're going to get more out of your dollars, and you have a little bit easier of like flow and maintenance. Part of the challenges with that though is when we start to come to the planning side and a client comes to us and they're now, 45 years old, and they're thinking the exit might be closer than I want it to. Let's start doing retirement planning. Let's start mapping out the future. Now we start talking about all of the other benefits that come when you're doing basically a blend of salary and dividends. So if we just stick to dividends for a second, the dividend tax rate that you get, what you would pay corporately, there's something that's called integration. And so CRA basically doesn't want you to pick a path that's going to be dramatically more tax efficient taking dividends than it would be if you took salary and dividends. At the end of the day, on the personal and on the corporate side, they're trying to make it about the same. And really what it comes down to is what's your short-term need? What is your long-term need? And what's the objective that we're trying to achieve? So a great point that you always bring up with clients is, by doing dividends only, you're not going to be contributing to CPP. And some of our clients, they have loads of money. They're not really concerned about what CPP is, but we lay it out in a very good way. It's indexed to inflation. You're going to receive it. You don't have to receive it at 65. You can delay it to 70. And then if you wanted to do something with that later, you could even, give it away. You could do CPP philanthropy at a later date. But it's your benefit and you're entitled to it. When you're doing dividends only, you are able to forego the dividend or the CPP contributions. So you are the employer and the employee. And so if you're doing dividends only, you're able to forego that part, it's like what, $8,500 a year right now. The challenge is if you're not contributing that money to CPP, you should be investing that in a long-term vehicle, where we see a lot of people not doing that. I think I have a lot more thoughts on this, but we'll continue through sort of our process of talking through it.
Yeah, love that. I think the process that Tyson brings is always really good because I go on tangents and I could just talk forever. But I agree. I think one of the biggest things about that is everyone likes to talk about multiple streams of income until it comes to CPP. And they're like, whoa, that's where I draw the line. One of the most important things we always talk to our clients about as the negative of just doing dividends is twofold. And Tyson just nailed both of them. Number one is the longevity risk that we see in clients nowadays. And I think that's going to be even more relevant later on because science and medicine is getting better. So people are living longer, but with less ideal health. So the longevity of your money is a very concerning thing. Like one of my family friends, they just celebrated their grandma's 95th birthday. My grandma lived over 100. Like it's one of those things that, it's longevity is concerning. So what you don't want to do is be running out of money in your most vulnerable years. So building a robust avenue of different streams of income, especially that are linked to inflation, very, very important. Whether you use it or not, to Tyson's point, is irrelevant. You can donate it later on if it makes more tax sense, but at least you're building it in the years. Because to Tyson's second point, what we find almost always, not fully definitive, but almost always, is that when that conversation from accountants usually comes in, is like, don't even do CPP, you can outperform that in your corporation. On surface level, that could be true, but when it comes to the behavioral finance or the qualitative side of your finances, people may do that for a couple of years and then they stop because it's very easy to find ways to spend money. So what we want to do is make sure that the things that your money should be going towards to build to your future is happening automatically. And then you can spend whatever you want later on guilt-free, but at least you're doing the right things today. So I would say that's a very big myth where dividends are always more tax efficient. Again, the word always kind of gave that away, but dividends are always more tax efficient is for sure a myth that we hear almost always, honestly, when we talk to our clients' accountants, even when we do year-end planning with accountants, like, that just dividend it out, and kind of go from there. So why don't we go into CPP, and then we'll go to the RSP room, and we'll kind of break down each one. So as you kind of talked about CPP implications, the fact that you don't get that when you do dividends, but, besides the fact that it opens up another revenue stream for doctors in retirement, why else is CPP relevant?
Yeah, I mean, CPP is one of those things where if it all goes wrong, if they make a big bet and it all goes away, it's not going to happen to any of our clients. But if it did, you have a guaranteed income stream in retirement that's there. You get certain benefits for it. So if the main income earner passes away early, the spouse gets a survivor benefit of the CBP to an extent. And so there's all these built-in safety nets that you can get there. It's good. It's not a bad thing. And so I think it's something to be aware of, and I think it's something to not be dismissed easily. On the same note, I mean, we are doing retirement planning for doctors that are going to have $100,000 or $200,000 a year or $300,000 a year that they could spend without risking financial ruin, given longevity risk and certain other things. So it's something to consider. But a good point that you always make is it's a risk-free like rate of return. It's an income stream. It's something that you're going to get. If you're a Canadian citizen, it's your right to receive this. We pay into it. And like, why are we dismissing it? It seems so silly to dismiss it. And some of the information that is tied to it is really old. It's like 20 years old. And so if we like zoom out a little bit, in 2000-ish, the CPP investment board was kind of founded, and they started changing CPP from like bonds only into a stock portfolio. It was like a balanced portfolio of stocks and bonds. They kind of completed that by about 2006. And then we had the GFC, the Great Financial Crisis of 2008. CPP was cut in half. Not good. Really bad. And this is where like it was the CGA at that time. It wasn't CPAs yet. They hadn't converted. So the CGA association was saying there's not enough money in CPP to fund like our generation when we retire. But since then, the CPP investment board has totally converted the way that they do their portfolio into one of the top asset managers in the world, not in Canada, but in the world. And it's billions and billions of dollars now in CPP because of the way that they manage it, making sure that everybody has the right to receive that. There's money that's going to be received, and the way that they're growing the pot of money is done really, really well. So that's my investment nerd spiel. There is money that's there. It's working. It's growing. If you're Canadian, you have a right to receive it.
Yeah. I just tack on two things there. When it comes to paying for CPP, no one likes paying for anything, and I get that. But what are you getting for the money that you're paying into it? And I think it's far too simple to just say, oh, okay, like I'm just investing to the government to get some kind of pension. What you're really doing is exchanging those premiums of what you're paying into the program in exchange for a annuity or guaranteed pension that's indexed to inflation. We keep talking about that, how it's indexed to inflation. The other thing that can help you is when you look at the estate planning way long term down the road, there's things that will cause tax problems for you, like your RRSPs. And I think that's something that there's a lot of literature about. People are starting to understand a bit more is in an ideal world, you don't want to defer all your RRSPs or your RIF later on and then pass away. It all gets deregistered, added to your last tax bill. And then your estate has to pay huge tax and everyone's upset. Having a stable source of income that's indexed to inflation again with your CPP, old age security, things of that such, it gives you a good amount of money that you can start to either donate that and get tax credits and use that to offset other stuff. You can receive that money and start to redeem your RIF and start to withdraw money from your RSPs because you have this guaranteed income. So sometimes people will donate it early in their retirement from like 70 to 75 or 70 to 80. And they're donating it, pulling money out of their RIF, and then they flip it later on, stop donating it, and then the RIF's a little bit lower, so their tax bill is significantly less for their estate. So there's a bunch of different reasons why it could make sense, but it goes back to the very beginning, especially in the early parts of your career. The compounding effects of you putting money into CPP are very, very, very strong. So opening up another revenue stream that you can do a bunch of different things with, why not? And it is not invested like it used to be where, for lack of a better term, it sucked. It was a bond. If we came to you as like, hey, you're an optometrist in Alberta and you're making a good amount of money, what we're going to do is build you 100% bond portfolio. You're like, get out of here, man. What are you talking about? And it was invested like that. So it's not invested like that anymore, but people don't know about it. They don't research it. They don't read it. They just do dividends. Who cares about CPP? And they're like, all right, sounds good to me. It's more money in my pocket, but it's less money in your pocket in the future, which is very important to know. So CPP, good things, implications of CPP if you only do dividends because you're not doing your CPP contributions. So that is one of the things you want to keep in mind for that. Moving to the next one is there's also RRSPs. And those are, tied into the fact of whether you do not do salary and you only do dividends, you're not opening up your RSP room. And I kind of just alluded to RSP room and RIF. So that's probably a perfect segue to switch over. So the second consideration of only doing dividends instead of salary, Tyson, is RSPs, if you want to take the audience through that.
Yeah. So when you are dividend only, it looks like you're not paying yourself on the personal side. You're just pulling money out of your corporation. The corporation's paying the tax. Whereas if we're doing salary or a blend of salary and dividends, now your corporation's going to issue you a T-slip because you are an employee of the corporation. That earned income gets taxed at your personal marginal tax rate, and you're going to generate RRSP contribution room, which is a good thing. It gives you a way to sweep money out of your corporation and get it into the personal pocket, which we always talk about. And you're going to get a deduction from your income for putting it into your RSPs on the personal side. So it's not a tax-free move, but it's fairly tax neutral most of the time to pull money out of salary and to contribute that to your RSPs on the personal side and build your retirement nest egg. So if we're doing dividends only, we have to have a valid strategy for what is the retirement roadmap? How are we going to get income out? What does the timeline look like? Because if they're planning on keeping their corporation open forever, are they factoring in the cost of running the corp, the accounting, the banking fees that you always talk about, just the upkeep and the maintenance? It could be thousands and thousands of dollars. And if they have a long retirement, I mean, we might be talking $60,000, $70,000, $80,000 of fees over the duration. Is that worked into the plan? Do they know that? So we want people to get money out of their corporation onto the personal side in a tax efficient manner and build them a kind of a bulletproof retirement war chest so they can pull the parachute and retire at any time that they want. They'll be fully financed. They'll have money in different pots because we haven't even talked about tax-free savings or other things. What RSP Room does, though, for you is if you are a incorporated professional and you're 40, 45, 50 years old and you've got a long track record of working there, you might qualify for an individual pension plan. That's not really on our docket for today, but it's essentially a supercharged RRSP program. You can stand it up. The equation doesn't make sense for you until you're at least in your 40s, but you get to buy back all your past service. So the actuary will do a calculation. So you've been earning high income since you were 25, 30 years old. You've been practicing for 15, 20 years. You might have $1 million of past service contributions that you can buy. You can use your RSPs for that, and you can top up out of your corporation. So that's a huge tax-free sweep from your corp into your personal pension plan. And then you get what's called a terminal funding. So when you go to retire at 55, 65, 70 years old, you also get a large balloon payment that you can pull from your corporation to fund your individual pension plan tax-free. It's a tax-free sweep. It's a business deduction for your corporation to get onto the personal side, which oftentimes is also close to $1 million. So you have the lifetime contributions, you have the past service contributions, and then you have the future terminal funding. We're potentially talking about millions of dollars, but you can't do that if you're doing dividends only.
Yeah, and honestly, I don't really have much to add there besides the fact that free options are always good. So Tyson nailed everything right on the head. And I think just, for all the listeners that are out there right now, just think to yourself in your own career path, if you are not going to have a sellable business, let's say a private practice, or, you're owning a franchise owner of or so you own a location for like FY doctors or dental practice or something. So if that is not an asset that you're going to sell as per your retirement plan and then use the lifetime capital gains exemption, you really just need to build up avenues to extract the wealth from the corporation to the personal side at some point. And your real goal is to smooth out your tax bill over your career as well as you can. And RSPs are a free option to that. And people oftentimes say, well, it's not free because I got to pay personal tax via salary. Well, to Tyson's point, it's kind of tax neutral because yes, you are going to trigger a salary. So you're going to trigger your marginal tax rate probably higher on the personal side, but you're going to remove that same marginal tax rate when you pop that into your RSP, and then you'll use it later on. So everything is about a calculation. So we can calculate how much money based on your retirement spending goals. What is your marginal tax rate in retirement going to be as you pull that money out on an annual basis, in consideration your government benefits as well. So now you can calculate what the the max RRSPs or max RIF you want to have eventually. And then you have a target. Okay, cool. So I'm tax neutral and I'm not in that space where my marginal tax rate in retirement is going to be higher than it is in my working career. That makes sense. And then once you get to that number, you can solve it with a bunch of different other ways. But if there's a free solution or a paid solution, why not go for the free one that's already there for you, which is your RSP in this case? So if you are doing only dividends, you're closing that door for the RSPs, and then you're only leaving yourself very expensive options down the road because you don't see it as a problem until it becomes a problem. And then it's too late to go back. So a lot of what we do as financial planning is opening up doors and avenues because your career can change very quickly. I think all of you on the call, or sorry, all of you on the podcast listening on whatever platform see that. Like I think your career in 2026 is very different than it was in 2024, and it'll probably be the same in 2028. So you may go back and add another, thing that you can do to add 15 to 20% to your revenue. So your life could materially be different when it comes to your income. So opening up other revenue streams is of the utmost importance. Awesome. So moving to another implication. So we talked about CPP, we talked about RRSP, parental leave. So a lot of our clients are planning to start families, or they did start families, or anything kind of in between. And parental leave considerations is a part of that when it comes to, salary or dividends. So it's a blind spot that almost no one plans for until it's too late. And obviously there's a caveat. Like I remember I had a client that we met and we onboarded them, and she's like, yeah, our goal the next 5 years is to start a family, buy a house, all that kind of stuff now that I'm in the income earning years. And all that stuff was great. 3 months later, calls me, hey, by the way, we're having a kid. Oh, we also put a down payment on the house. I'm like, holy cow, everything changed real quick. So obviously we can kind of map out as much as possible. And, we have situations where clients are like, a lot of doctors are kind of like that. They're very linear in timelines where like I had a goal and I graduated this date. Now I have a goal to do this. Now I have a goal to do this. And you could be very clearish where it's like 5-ish years is my plan that I want to do to have kids, and we can build your finances to be like that. They build up EI contribution rooms and things like that. But other times it's like, it just kind of happens, and either one is fantastic and a blessing. But, if you want to plan for having a family and you're not doing any salary, it could impact you a little bit. Tyson, why?
Yeah. So if you're expecting to get your like EI paternity benefits, it's based on salary earnings. And so EI is based on insurable earnings and what's reported. And we need to have a track record of T4 income or T4A income from your company to you paying as salary and paying tax as salary. Some of the deductions that come off of there are in your personal taxes, and then whatever other like benefits and stuff that your company might provide to you as health benefits. But if you're paying dividends only, you don't really show up on that map. You don't have any insurable earnings that show. And so you don't get to claim EI. You have to fund and finance your paternity leave yourself. We have had clients that do that, but we recommend then like having a full, 12 to 18 months worth of your income needs as retained earnings in the corporation so that you can flow those monies out when you need. But again, it's another benefit that's there, that's available, that you're sidestepping because there hasn't been a lot of planning, or maybe it hasn't been talked through to say like by choosing this, you're foregoing these options. And I think it's not anybody's fault. We're not here to talk bad about any of our partners in the industry because they are partners. But I think about how hard it is to get an appointment with your accountant. How much do you talk to them, and how much scope do they really have to cover in the 25 minutes, 30 minutes that they're talking to you? It's really tough for them to cover every option and every available planning tool that's there, which is why the financial planning team comes in and we really look under the hood and discuss options and choices with clients.
Yeah, just to add on to the accounting thing, I literally just had a conversation with a client last week about this, and they were saying the same thing about their accountant, and I was like, yeah, heard them out, but I'm like, to be fair, it's not fair professionally for you to expect them to do all these things for you because that's not their scope, that's not their specialty, and they don't have the capacity to do that. They're building a practice based on your tax returns and your tax filing. And it's the same thing as, going to your optometrist, getting your eye exam, and they're like, yeah, your prescription isn't 2020 anymore. It's this. And you're like, okay, do laser eye surgery for me right now. And they're like, well, I don't do laser eye surgery. Like, well, like you're my optometrist. You should also do my laser eye surgery. So it's the same kind of thing. There's, certain times that you get triggered into the point of like, hey, you need to start doing financial planning. And we get a ton of referrals from our accounting partners for the same reason. Once that triggering moment happens where their client starts getting into shareholder loan problems and things like that, they're like, hey, you know what? You could really benefit from financial planning. go out to this firm and they'll kind of set you up. It's the same idea when it comes to your family doctor, not being your cardiologist. You're not going to go to your family doctor, book an appointment and be like, okay, cool. Like, since I have you, can you just do some, put a stent in for me real quick? Like, no, that doesn't work. So it's also, to be fair, professional to your accountant. They can't do everything all at the same time. The same as you can't do all the subspecialties at the same time as well. But yeah, so, going to parental leave, I think there's a bunch of different ways to kind of plan for it. So I know in like BC, for example, if you're a physician in BC, you get the PDI insurance if you opt for a C-section, or if a C-section happens, you can claim your disability insurance and collect that money. And that would be on top of your EI. So, we had a client who took $0 in EI during her parental leave because she was just doing dividends only. And it was one of those situations that we got engaged basically right as she was prepping for going on to parental leave. And the only real option is use your retained earnings as kind of your parental leave. So that was one option. They got $0. We had another client who had $35,000 from EI. They got paid the same. They just structured their salary and their compensation differently. So one did dividends only, one paid the same amount of tax, but did a blend of salary and dividends because, again, the salary triggered tax, but it went to RSPs and offset some taxes and things of that type. But earned income triggers EI and it allows you more flexibility. Again, flexibility is key in your parental leave because, yes, there's EI thresholds for clawbacks and things like that. But for special benefits like parental leave, there's a lot of exemptions for that. So you could get your $35,000 from your EI and then a bunch of other things as well. If you need to pull extra money from your corp or whatever, it just adds another layer of your financial plan, which is great. So EI is also a thing that you're giving up if you're only doing dividends instead of any kind of salary. So it's the way you compensate yourself. The same $150,000 is $150,000 on your personal side. It depends how you're declaring it when it comes to your taxes. So we got one more, and then we'll kind of jump in our prescription pad. Just be mindful of time here. So retained earnings. So retained earnings is something we talk about very, very, very often because our client base is all about retained earnings, and I think that's so important to know. But the third option is kind of hiding in plain sight, which is if you just do dividends, you cast implications on your corporate retained earnings, which is your leftover money that you've pulled onto the personal side. For those who don't know, that's what retained earnings are. So what is that last implication that people need to consider when it comes to dividends or salary in regards to your corporate retained earnings?
Yeah, I think corporate retained earnings, it's funny. Sometimes we see retained earnings on the balance sheet from accountants, and there's actually no money there. But when there's retained earnings and there's money in your corporate account, there's things that we want to do with that. And I think it's a great option, right? It's a great safety net. So number one, if you have lots of retained earnings in your corporation, I think you should be investing those. I think they should be growing tax efficiently. And you want to make sure that they're set up properly. We have seen people get the advice that you want that money safe and available. So what they do inside their corporation is GICs. GICs are not tax efficient. So if you're earning 3% on a GIC, passive income rules inside your corporation is a 50% tax. So you're actually only earning 1% on a GIC. It's not good. So I think you should take your retained earnings and invest those and have them grow. It's a great war chest. And so we talk about this from a couple of different points. Is in the instance that you want to take parental leave and you've been doing dividends only, you now have a source where you can continue to dividend yourself income. Or if you were taking a salary and dividend blend and now you're getting your parental leave, but you need a top up because babies are expensive. Or you need to renovate your house, or you need to upgrade from your cool sports car to a cool minivan, which I've been telling Vishal to upgrade to.
That's what I draw the line.
I've been a minivan driver for like 20 years. They're very handy. Having access to funds that is lightly taxed corporate dollars is a really good option. And so some people want to do that for the parental leave portion where we're talking about topping up your income, making up the difference, unexpected expenses, or the opposite direction is like looking future forward. You want to buy into a clinic that you're working at. Maybe you're an associate there. Now you want to be a partner. That is your war chest to buy into a practice, to build a business, to do something. So those retained earnings that you haven't spent that are in your corporation, they have a lot of optionality to them, and it's a good thing. So it's just, most of our physician clients, very, very responsible with their money. We've got some other professions. They are high income earners and they are high income spenders. And that's wonderful, but we want you to have some money to pivot and make some really big moves.
Yeah, and I think that's a good segue into our last thing before we jump to our prescription pad is why your accountant defaults to dividends. And I see this very often in tax time. And again, to be fair and transparent to everyone, this is the reality of it. The reality is, from the accountant's perspective, their client spends the money throughout the year. So they don't talk to them throughout the year. And then they come to them at tax time and say, okay, Tyson, you have a $230,000 shareholder loan, which is overdrawn from your corporation. Tyson's going to say, oh my God, that's crazy on top of everything else that I spent. They're like, no, like you spent $230,000 in 2025. So for tax time, we need to declare for the 230, how are we declaring? Are we doing dividends or are we doing salary or, what are we doing? For the most part, if you are one of those types of clients and you don't have a financial planner, you also haven't been contributing to your RRSPs. So if you do declare any of the 230 from or to a salary, then that triggers higher personal tax rate. Your overall tax rate is the same because you're getting a deduction in the corporation. It's integrated. However, that tax due is due on the personal side and you've been spending this money, but you've not kept any of it on the personal side. So if you were to declare salary of your $230,000, you need more money on the personal side to pay the tax bill. So you're going to draw more dividends in the next year. So that's usually why we see people doing dividends only. It's usually a indicator of the symptom of not having a good plan. It's the same thing as if you go into your doctor's office and they can check your blood pressure. Like that's usually telling me that they have some other kind of underlying issue. Usually when we see people pay themselves just dividends, it's a tell of an underlying symptom, which is bad cash flow planning. So that's usually what happens. It's not your accountant is giving you bad advice. They're usually not left with any other opportunities because by the time that your taxes, RRSP season has passed, you have drawn $230,000. You have two options: show it as a salary or show it as a dividend. And you're going to say, hey, I never kept enough money on the personal side to pay for this personal tax bill. So I only have corporate money. So that'll land up to, okay, well, let's just do a dividend. Then you can pay that same tax bill, but you're going to pay from your corporate account. And then let's try and fix it for next year. But next year's not going to get fixed. And you do the same thing over and over and over again. 7 years go by, 7 years of dividends, and 7 years of no CPP, no RSP, no parental leave. And it just ends up being quite chaotic. So it's not your accountant's fault. It's a sign that you need to get some financial planning. So if you're one of those clients that, one of those doctors that are listening and you're saying, oh, wow, this all sounds like me and I've only had dividends, talk to your financial planner, build a plan, because everything can be based on a calculation of, knowing what your risk maximum should be, knowing what your retained corporate passive income should be, like how much money or how long do you have until you get into these problems? And that's what your financial plan team can help you with. So on that note, let's switch over and let's wrap up with our prescription pad before we get out of here. So a couple questions is that we get from our audience. And again, as a reminder, if you want to get questions into the prescription pad on this segment, get your questions answered live, is join our Facebook group, Doctors in Canada Wealth Forum. It's going to be linked to the show notes as well. And these are ways that you can ask your questions to get answered on the podcast. And then we'll go further detail on the Facebook group as well. So question number one, knowing your RSP room. I think we talked about that as well in our last episode, the one before that, but I'll answer it real quick, is just log into your BuyCRA account. It'll be on your bottom right-hand side for the most part. If you log into your computer, that's where mine is. It'll also be on your notice of assessment when you get your taxes completed. Give it a little bit of time. It usually kicks in like a month or so after tax time is done. But your RSPs are going to be based on your last year plus any carry forward room as well. So if you want to know your RSP room and you're like, hey, I think I may be running an issue that I've been doing dividends. I don't know if I have any RSP room. Check that out. It'll be in your My CRA account on the bottom right-hand side or your notice of assessment. Next one is the cost of CPP. So one person asks the cost of CPP, how does that get paid? Because I thought I just paid one side. So as you kind of talked about this, but if you want to go a little more detail about CPP contributions and where that comes from.
Yeah. So CPP contributions, you're paying, it's about $8,000 a year at the maximum. So you're paying part of that corporately as the employer, and you're paying part of that personally coming off of your paycheck, your salary as the employee. So you're both contributing. So like when you have a job and if you're working for another company, you usually only see one part because they're paying their part behind the scenes and you're not aware of it. So it's about $8,000 a year contributions. You're paying part, corporations paying part. If you're an incorporated professional, you just feel the pain on both sides. That's all. That's the only difference.
Yeah. I would say one thing to know in there is it's a deduction on the corporate side too. So it is always nice to get deductions whatever you can. So Tyson mentioned this, I think 3 times on this episode, but it's an integrated tax plan. So as much as everyone hates on the CRA, which there's a lot of things they don't do right, it is also, you get some deductions on that side. So whether you pay things corporately or personally, it does kind of blend out. So salary ends up not costing you as much as long as you plan for having the cash on the personal side. That's the only thing, but more or less it's the same bill, which is nice. Next one is you talked about passive income, but one question we had here was about deductions. They're talking about salary. So yeah, deductions. So how does salary create a deduction in my corporation?
Yeah, salary for your corporation is an expense. It's an item on the it's a line item for your corporation that you're paying out, just like you have licensing subscription fees for your Microsoft or for your equipment. Your staff, which is you, is also an expense to the corporation. So that money gets paid out. It gets deducted from the income in the corporation, which lowers you and maybe even lowers you below the small business deduction limit. So you're in that nice small tax bracket corporately. And then you're paying tax on the personal side on your personal marginal tax rate. Like Vishal was just saying, it's integration. But corporately, sometimes we see strategies where, a client's making $600,000 a year in revenue in the corp. Let's pay ourselves a little more salary this year to bring that threshold down. So we're at that nice 11% in BC, small business deduction tax limit, and get that efficient tax rate. It's a nice little maneuver that you have available to you.
Yeah. And the only thing I would say is, salary is one of the biggest deductions that you can get and the easiest deduction you can get inside your corporation. So if you're at that point where you're over the small business limit, so you're earning $600,000 after all your other deductions, so your net income is going to be 600K and you're going to be in that general tax rate. The quickest way to get yourself in the small business tax rate is to kick over 100K onto the personal side via a salary, and then you'll get a $100,000 dollar for dollar deduction inside your corporation. Last question before we get out of here is going to be in regards to compensation. So there was a person in the audience here that said they have done salary and dividends. And is it fair to assume that I can stick with this same blueprint for the entirety of my career, or does that have to change year over year?
I think it could change. Again, we don't want to speak in absolutes, because to say this is what you should be doing and we make a plan. I mean, the joke is if you want to make God laugh, you tell him your plans and he's going to throw a whole bunch of things at you, right? So we want to have a plan. The reason that you want to have a really, really good financial plan is so you can flex away from the financial plan and always revert back to it, revert back to the mean. Because as soon as we make a plan, that instant we have a picture and we have a roadmap for you, something's going to happen. You're going to have a new child. You're going to get married. You're going to get divorced. You're going to get a new business partner. The roof is going to blow off your house. Something's going to happen that was not anticipated in the plan. And it is comical, and it's sometimes tragic, and it's hilarious. It's all of the things, right? So you want to have a really good plan so you can flex away from the plan, but always come back to it. And you want to have a team that understands that you want to have some optionality. You want to have some breathing room built into your plan, because life is going to happen. And yeah, the blend of salary and dividends, it might change as you go through the seasons of your career and you're really starting to prepare for other things in the future. I think where we see people who work in absolutes, it's costing doctors hundreds of thousands of dollars over their lifetime because they're trying to pay zero tax this year versus building a roadmap of tax efficient income and reliability for their plan and for themselves in the long term. And so just to pay the least amount of tax this year, they're sacrificing things that are in the future without knowing it usually.
Yeah. Really well said. And that's hopefully a good blueprint for you all to understand the difference of salary and dividends. As we mentioned at the start of this episode, that decision, if you don't make it correctly, compounded over the entire career, can have catastrophic results on your finances. So oftentimes your goal is to open up as many relevant doors as possible, as long as it makes sense with the overarching theme of your finances and your career changes. The world you are in today is very different than the world you were 3-4 years ago. And I can promise you it'll be the same 3-4-5 years down the road as well. So a good financial plan goes with you as well. And if you got some value out of this, make sure you join our closed Facebook group to get your questions into the mailbag segment of our show. Also to follow along with more education that we do on the Facebook group, and like and share and subscribe. And we will see you next time on Portfolio Talks.